Welcome to another episode of Healthy, Wealthy, and Wise Retirement Podcast, where certified financial planner Lauren Sherman shares thoughts on having a healthy mind, body, and spirit, an abundance of wealth inside portfolios and out, and lessons learned from clients and mentors over the years.
Welcome back, and thanks for joining me for this week's episode titled 5 Tax Planning Opportunities. Of course, I am your host, Lauren Sherman, and while I am a certified financial planner and have several other designations that integrate tax planning with financial planning, it's still incredibly challenging to offer meaningful tax planning without some powerful technology behind the scenes. Trying to offer tax planning without using technology would be a little like trying to solve complex math equations without using a calculator. No matter how smart a person might be, they are bound to make some errors if limited to the space between their ears. So with that introduction, in this week's episode, I will talk through some of the technology our firm uses and some of the opportunities it helps us uncover. But before diving into that, how about a quick story? Roger, now in his late 80s, grew up in a small town in Iowa, worked on the family farm almost his entire life, and considers himself to be a bit of a car enthusiast. He's even owned a few classic Mustangs throughout his life and still enjoys his Sunday cruise around town. Roger is a pretty healthy guy and sharp as a tack, but his memory sometimes fails him. When he struggles to find the right word, he often jokes that it's not Alzheimer's that he has, but just a case of old-timers. Of course, during his Sunday drives, Roger would occasionally need to stop and fill up with gasoline. One detail that would always escape his memory would be which side of the car the gas tank was on. It's not like Roger was buying a new car every few years to keep him guessing, but the local boys working at the convenience store would witness Roger pull into a spot only to circle around once or twice more to maneuver into a new spot where his gas tank would be properly positioned to fill up. Mind you, Roger is in his late 80s, so he's not a fresh face with a brand new driver's license figuring things out on the go. This continued on until one day, someone at another pump witnesses Roger continuing his same routine of pulling out, then reversing his car back into the same pump moments later. This onlooker decided he would do his good deed for the day and told Roger, "You know, sir, if you take a look at your dash, there's an arrow on the fuel gauge that tells you which side of the car the gas tank is located." Now, I imagine most of you listening are thinking, of course there is. There's probably a lot of you who are also questioning, perhaps with a little disappointment, this story started talking about classic Mustangs and it ends with the fuel arrow? And I imagine there are one or two of you who are heading to the garage right now to confirm this newfound piece of information. With that said, all of you are probably asking yourself how this story applies to our topic of tax planning. Well, for the average retiree, a lot of tax planning in relation to your financial planning falls into this category of, I didn't know what I didn't know. Sticking with the car analogy, sometimes it's something relatively simple, like when Roger discovered that he can just take a quick peek at his fuel gauge and always park on the correct side of the gas pump. It could also be something more complex, like rebuilding an entire engine for your classic Mustang. The point is, just like with our fuel arrow example, we have to be aware of the details when it comes to tax and retirement planning. Further, a lot of the do-it-yourself programs like TurboTax have helped educate Americans on how to do their taxes, but this can also give us overconfidence. For example, many know that an aspirin can save their life if they are having a heart attack, but not everyone knows to chew it, so it dissolves and gets into the bloodstream quickly. Many know the story from the Bible in Genesis when Adam and Eve ate the forbidden fruit, but instinctively, most people envision an apple. In reality, we know it was a fruit, but it could have been a fig, a banana, a grape, or any number of other fruits. While those first few may not have stumped you, did you know that Frankenstein was actually the name of the mad scientist and not the monster he created? The monster was never actually given a name and is mistakenly referred to as Frankenstein himself. This may feel like I'm going off the beaten path a bit, But when I've talked about tax planning in the past, I've noticed that months, weeks, or even a few days later, most retirees don't remember the specific tax advice as much as they do the analogies and stories I've shared. So if nothing else, remember that when it comes to tax planning, much of the battle is knowing what to look for, just like with our fuel arrow, and not everything is going to be simple and straightforward, as is the case with the aspirin, the forbidden fruit, and our mad scientist named Frankenstein. As we dive into some specific tax planning opportunities, remember to check out our resources in the show notes. This is probably even more important for this episode specifically, as the show notes will include a short video so you can see these tax planning opportunities in action. It will also include a sample tax report. And finally, there will also be a link where you can take advantage of securely uploading your own tax return if you'd like a personalized review. Let's start with the first opportunity we can identify by running a tax report, which this one isn't even directly a tax planning opportunity, but it's so related to what we're trying to accomplish that I think it will be helpful. So first, we can back solve for what was spent in the past year. This can be really helpful from a financial planning perspective, as most people are off by more than 20% when they try to calculate their spending. Say, for example, that a retired couple is considering buying a winter home down in Florida to avoid the snow and frigid temps that they get each year living in the north. They estimate their annual spending to be about $50,000. But if they are like most people, and they could be off by roughly 20%, this means they could be spending as little as $40,000 or as much as $60,000. So when they come to their financial advisor for input, we need to pinpoint which figure is accurate. This range between $40,000 and $60,000 could make the difference between whether a vacation home is a viable option or not. Let's move on to a second opportunity that we can identify using our tax technology, which relates to capital gains. I've talked about this at length in a past article and podcast episode, so I will link both of those in the show notes for reference. But what our tax report can easily identify is whether or not we have any wiggle room to harvest some of our investment gains without paying any tax at all, at least at the federal level. This is an opportunity we want to be sure to take advantage of because, like many planning opportunities, if we miss it any particular year, we cannot recapture that in later years. We can still use the strategy in future years, of course, but we can't go back and refile, for example, to take advantage of that tax-free income. Similar story on the other side of the coin with capital losses. Our tax report will diligently track any carry-forward losses so they get reported on our next tax return. This is important because a lot can happen in a year. Think back to your last birthday, or if you just recently had one, then think back to the one before that. Can you remember what you did for your birthday? Have you gone on some trips between now and then? Any major life events, maybe graduations, sports games, or maybe you even added a grandchild or two to the family. Even if there's not a lot of specific memories that come to mind over the past year, that's still a lot of days if you are trying to go into your memory bank for specific details. And when it comes to taxes, not remembering these details can be a costly oversight. And last, with regard to capital gains, we can track your short-term versus long-term gains. Short-term gains tend to be taxed at a much higher rate. If we are seeing an excess of short-term gains, there's probably some planning mistakes we are making, and we will need to correct this to avoid offering up more in taxes than is necessary. For our third opportunity, we take a look at charitable gifting. This one can go a few different directions, but for today, we are specifically observing how the amount of the charitable gift compares to the standard deduction. To take full advantage of a larger charitable gift, we will want to itemize our taxes, which means we will want to be aware of mortgage interest, healthcare expenses, and so on. It could also make sense to break the gift up into every other year or every few years to get the most tax benefit. A simple example is that instead of gifting $10,000 every year, perhaps we want to gift $30,000 every 3 years. That way, you only need to itemize the 1 year and can use the standard deduction the other 2. An easier way to do this may be to use a donor advised fund, which allows for an immediate tax deduction, then your gift is received over time. We are also looking at opportunities for a tax-free qualified charitable distribution out of an IRA. This is just a fancy way of saying that once we're at the right age, specifically 70 and a half, we have an opportunity to bypass the tax altogether. Let's talk through a simple example. Say you wanted to make a large donation to your favorite charity, but instead of waiting until you pass away, you'd like to do it while you're living so you can see the benefits of your gift. If you were to make a larger donation out of your IRA of $100,000, for example, depending on your income, this would likely be taxed at least 32%. And if you remember from past talks regarding taxes, moving one lever or variable can often inadvertently move a couple others. So what this means is that you will likely pay much more for your Medicare coverage, Parts B and D. You might also cause capital gains to be taxed at a higher rate, and so on. At the end of the day, your generous gift likely caused some tax frustrations for yourself, but it also means your favorite charity only received $68,000. Remember, this is the $100,000 minus the $32,000 in taxes owed. By instead using a qualified charitable distribution, this same gift could be made without losing $32,000 to taxes and without causing unnecessary headaches with your Medicare premiums, capital gains, and so on. All of this is getting a little specific, but the point here is to just be aware that there are many variables to consider, but proper tax technology will take this into account for you. Let's wrap this up with our last 2 tax planning opportunities. Let's take a look at the opportunity for Roth conversions. This is another strategy I've talked about in the past, particularly with what I would call outside considerations, meaning even if the technology does not clearly show that a Roth conversion is beneficial, there may be outside considerations, such as the expectation of tax brackets to go up or the Tax Cuts and Jobs Act sunsetting after the year 2025, that both could impact your decision. If you watch the video included in our show notes, you will notice how Roger Pine, one of the creators of this technology we use called Holistaplan, Roger talks about filling up tax brackets. This is the same language I often share with clients and is the reason why we would sometimes recommend taking taxable income from your IRAs even if you do not need the income. Of course, you can turn around and invest this money right after paying the taxes on it, so it's not like you have to spend it, but we want to make the best use of each tax bracket. I'm big into telling stories to bring these concepts to life, so you'll have to forgive me if you've already heard enough for one episode. I promise this will be my last one, but I want to be sure that we drive this point home. Imagine you are going to plant a whopping 30 trees in your backyard over the next few months. Under normal circumstances, you would be encouraged to buy in bulk by getting a better deal the more you purchase. But right now, the nurseries have a shortage of inventory. They've allowed each household to purchase a maximum of 10 per month at their standard rate of $300 per tree. If you want more than 10 in any given month, they will charge you $500 for every tree beyond the 10th. Further, they will charge $800 for every tree beyond the 20th. Now, stick with me for a minute because we see this opportunity missed in nearly every tax return we analyze, or at least it's overlooked in certain years. With the tree example I just laid out, most people intuitively know that it makes sense to purchase 10 trees per month over the course of 3 months. This way, you never had to pay more than the standard rate of $300 per tree. All in all, you paid $9,000 for a fully planted backyard. Our next homeowner, let's call him Unsure Sam. He did not follow the same plan as you. Instead, he got 12 trees his first month, 3 trees his second, and then 15 trees the third month. He still ended up with 30 trees just the same, but he paid $10,400 for his backyard. Now, our third homeowner, let's call him Procrastinating Paul. He bought no trees his first month, 2 his second month, and the remaining 28 his third month. Paul ended up paying $15,000 for the same backyard as you and unsure Sam. Procrastinating Paul would be a perfect example of what can happen to retirees when they do not do any tax planning before age 72, at which age the government requires distributions from tax-deferred accounts. I won't go into more detail on this for today, but this is definitely something to be aware of as it becomes a bit of a tax time bomb for some retirees. So while the solution to our tree buying example is pretty obvious, it's a mistake that many of us make when it comes to tax and retirement planning. Let's hit our fifth and final opportunity: reviewing Schedule B for any assets we have not taken into consideration. I told you I was done with stories for today, but this goes back to the analogy I've used in the past of completing a puzzle. The first step is to dump out all of the pieces and take inventory. When you know what the final picture will look like, it's going to be much easier to say what each individual piece represents. As an advisor, tax and financial planning is challenging enough on its own. If there are accounts or variables that we are unaware of, this is going to make the process that much more difficult and could lead to poor advice and feedback from your advisor. Think if you are talking with your auto insurance company and getting coverage for each vehicle. You're not going to be very happy with your insurance agent if you get coverage for your 2 primary vehicles, but forget to tell them about the Harley and the Mustang in the side garage, particularly if you got into an accident. Tax and financial planning is similar, as it's vital to take stock of all of the assets and information that we can. That will do it for today with 5 tax planning opportunities that retirees should be reviewing. I know I've mentioned this before, but to reiterate, most financial firms are not well equipped to offer tax planning, or in many cases, they simply are not allowed to due to their firm's restrictions. If you need help figuring out if this is something your advisor can offer, or to connect with someone in your area who could review this, reach out and we'd be happy to do some homework on your behalf to find someone. Of course, we would be happy to offer this on our end as well. Just take the first step by creating an account using the link in the show notes, and you will upload your most recent tax return to your personalized vault, which, once you create an account, you will find this by clicking the 3 dots in the upper right-hand corner. As always, this does not obligate you to pay for any of our firm's services, and I'm sure this isn't something I will be able to continue to offer each year, but at least it's a one-time gift from me to you. And I know I mentioned this at the start, but some of the stories we talked through today were a bit off the beaten path, but there is actually some rhyme or reason to this. If I only share a quick story about how to use qualified charitable distributions, or why you should do a Roth IRA conversion, for example, these terms tend to go in one ear and out the other. I've found that stories, on the other hand, whether it's about an old man on his Sunday cruise doing loops at the gas pump, or planting an abundance of trees in your backyard, these stories tend to be remembered. So thanks for sticking with me through this ride we take every 2 weeks. As always, you can find past episodes at healthywealthywiseretirement.com. Again, be sure to check out the show notes for this episode, as we have some great resources included today. Take care, and we will talk again soon.
Thank you so much for listening and supporting this podcast. If you've enjoyed listening, we would love if you took a quick moment to leave an honest review. Of course, we're shooting for 5 stars, but if you have suggestions to improve the show, we would love to hear from you too. Just click on the podcast name, Healthy, Wealthy, and Wise Retirement Podcast, and scroll down to ratings and review. Thanks again for your support, as this helps us reach a wider audience and help even more retirees just like you. This podcast is for entertainment and informational purposes only and is not intended as a specific tax, legal, or investment advice. Lauren Sherman is a certified financial planner and co-owner of Integrity Wealth Management, an investment advisor serving retirees in search of their own healthy, wealthy, and wise retirement lifestyle.